The economic calendar has been sending mixed messages, but based on the latest development, the trend may now be clear. Last week, we were inundated with a number of jobs numbers that will help demonstrate exactly this. First, the bad news ADP. We should be skeptical. Economy is losing jobs for the first time in years. This is ADP private payroll, losing 33,000 jobs. This is the first decline to negative territory in quite a long time. Certainly not a good turn of events. Now we have several subsectors like financial activities. That's losing 14,000 jobs. That's the first negative territory number since last September, and certainly a big dip. Now, the different lines represent the different size companies, from the very small companies with 1 to 19 employees to the largest ones. What you'll notice is that all companies are moving lower. Hiring is slowing on the small, medium, large, and very large companies. And that is certainly not a good turn of events, to say the least. Now, here's some good news. Last week, it was also reported U.S. JOLTS job openings surged to 7.77 million. That's exceeding forecasts. We're talking about the JOLTS numbers. The hires, this is reported in thousands, so we're looking at 5.5 million. That's a pretty good number. The second highest in quite a long time, actually, going back to September of last year. The layoffs and discharges, 1.6 million. That is a good number because it's low. They're not laying off so much, and that certainly is a good sign for the future. Here are the job openings. They're increasing, 7.7 million. That's the best number we've seen pretty much all year, actually. Also, we have the JOLTS quits. Now, that's at 3.2 million, and that is rising, but that is not necessarily a bad thing. If we feel more confident about our prospects of getting a new job, well, the quits rise because, we want to go get more money somewhere else. Now we have total separations. That includes the quits and the layoffs, etc. That's at 5.2 million. That is more or less in line. So certainly the quits are rising faster than the layoffs, and diving into that data, that's a good turn of events. Now we also have some mixed messages, and that comes from non-farm payrolls. They jumped to 147,000 jobs in June. That exceeds forecasts. The forecast was actually quite bleak, but 147,000, that's the best number in 2 months. The second best number all year, in fact, and that is certainly a good harbinger. Now, breaking this down, non-farm payroll goods, creating only 6,000 jobs. Well, I guess that's not really where the growth is. Here's a private sector overall, creating 74,000 jobs. That's a dip as well. So if the private sector's declining, or not declining, but growing less than we would hope, and that includes the goods, where's the growth? Government, 73,000 jobs. That is the best number we've seen, well, since March of 2023. Lots of government jobs being created, according to this figure. Now, the unemployment rate dipped from 4.2 down to 4.1%, most likely related to the surge in government jobs. So diving into this data, on the surface, it looks good, but we'd like to see more private sector jobs. And 4.1, that's a dip. That's good. But we'd like to see the goods and services increase, which it certainly is not. The labor force participation rate, not so good, 62.3%. That is the lowest level we've seen in years. Going back to late days of 25, early days of 2024, we had almost 63% labor force participation rate. These are minor changes, but they really do mean a lot. And this is not going in the right direction. So overall, the non-farm payroll number, it's giving us mixed messages. And that's certainly not, what we want to see out of this report. Now, what does it all mean? Well, the columns here that show us the probability the Federal Reserve will not cut interest rates in July. In yellow, that's the S&P 500. So at the end of the day, what's the consensus about the jobs numbers, the ADP, the JOLTS, and the non-farm payroll? Was it good? Was it bad? The market tells us. We now have a 95% chance the Federal Reserve will not cut interest rates in July. This is from last Thursday's data, reacting to all those jobs numbers. And that shows us that the Fed funds futures, the futures market, interpret all of these numbers and say, well, the economy is not that bad. The Federal Reserve does not have really much reason, much justification to cut interest rates. We've spoken about this in the past. We need a big shock in order to shock the market and the Fed into action. And that's not the case right now. The jobs numbers were good enough, on the surface and non-farm payroll, it was good enough not to indicate that the Fed should cut rates. Quite the contrary. So what's the next market mover? Well, the stock market's near all-time highs, and the Federal Reserve, according to the futures market, doesn't have any reason to cut interest rates, and that has a positive correlation. But now, over the weekend, the White House suggests some countries could see a tariff deadline shifted. Now, this could be good news or bad news. This is something that we really have to really kind of monitor because it could go in either way. So far, we have the tariff deadline coming right up July 9th. Right after that, really, the brunt of the earnings season. And the tariff deadline is probably the biggest risk factor to the stock market. Remember what happened in April? Well, now there could be two possible outcomes. One outcome is we see a reversal, a boomerang, as they say, back to full on tariffs, and that would not be good. Or there's other, ideas that they could push a tariff deadline into August. What would that do? It would push a tariff deadline till after earnings season. Earnings season is one of the most volatile times of the year, and we don't want that volatility mixed in with a tariff discussion. Best case scenario, if the tariff discussion is pushed off until August, where all the market has to worry about right now are how good are Nvidia earnings and Apple earnings, well, that could lead stocks much higher. After all, we're flirting with all-time highs almost on a daily basis. However, if the tariff debate pushes, the tariff discussion and mixes it in right in alongside with the earnings season, well, that could spell some trouble for the stock market. So this really is the biggest risk factor. But again, if they push a tariff discussion off until August, that would be fantastic news, I think, for the stock markets. In terms of the earnings season, well, the brunt of it is in July. Take a look at this week alone. We have names like BlackRock, Citigroup, JP Morgan, Wells Fargo, Bank of America, Goldman, Johnson & Johnson, Morgan Stanley, lots and lots of big companies. American Express, Schlumberger, Taiwan Semiconductor, Netflix. That's just this week. July has a lot of big, potentially market moving events in the form of earnings. And again, we do not want this mixed in with a tariff discussion. Let's hope the tariff discussion is pushed off until August. In terms of this week, we actually have a light economic calendar. We have minutes for the Fed's May FOMC meeting that will be released on July 9th. That's Wednesday. We have initial jobless claims, a couple of Fed speakers as well. But again, the really big news are earnings and hopefully a delay, procrastinating the tariff discussion until August. We hope this has been helpful. We look forward to seeing you back soon.